it is interesting. You know, we've seen markets move on the drop of any piece of news out, and this would seem to have rattled the markets, or you would think it would, but it hasn't. So why is that?
Well, it's, I think, a couple of different things. The first is obviously we've had a couple of days of a very sharp sell-off related to oil prices and global markets selling off in concert with that. And so we are really oversold. So to some degree, there's a natural lifting effect just as we get through that pressure and hopefully have a better day today. But at the same time, this story is still developing, so I wouldn't discount it at all.
No, and Carl, you know, it is interesting because it also, as Nick is pointing out, it seems like some of the news out in the U.S. is overshadowing even the tragedy and the concerns here, which is the jobs market, right? That it seems as if, we saw with ADP, that the economy is still humming along here.
Right. We had two key reports this morning. The ADP survey showed private sector employment probably holding up near trend. November was an anomaly when we saw that big surge in non-farm payrolls. We'll have more evidence this Friday with the December jobs report. But ADP tells us that everything is still holding along at that healthy pace we saw in the back half of last year. I'm not saying we'll see 5% GDP growth in the fourth quarter, but it does look like it's going to be, let's say, 3 to 3.5%. That's an economy that still looks pretty decent and therefore is resilient to some of these exogenous shocks.
Well, investors are focused on the Fed, obviously, and what they're going to do at their meeting later this month. And we're going to get the minutes out later today. So what is the expectation there? Right.
So the minutes are out this afternoon. The Fed does not want to cause big market gyrations. And after the Yellen press conference, we saw, you know, a big surge in the equity markets. That certainly was not what you wanted to happen.
No.
Then that bled into the Santa Claus rally, and then we get into the January hangover, and things are tanking. They don't want to be causing that kind of volatility. They want to be very transparent with the exit process. And what was interesting in the last meeting statement, they expressed concerns about deflation and low inflation pressures, but they went on to say it's not just oil prices, it's other factors as well. So that's going to be the key point.
And also the lack of the
for.
wage growth.
Exactly. So weak wage growth and other deflationary forces, that's what we have to watch for in the minutes today. Further clarification on that front.
Nick, how closely are you watching these minutes?
Very closely, and it's very interesting to note that the Fed funds futures market doesn't believe the Fed's color at all. It doesn't believe the Fed's going to be raising rates 2, 3, 4, 5 times this year. It believes 1 or 2 boosts of 25 basis points apiece between now and the end of the year are much more likely. The one-year T-bill says exactly the same thing. So the Fed can talk about what it sees, but the market's already made up its mind.
They seem to have, right? And in fact, it seems almost as if they're not even counting on a rate hike by the summertime even, right? I mean, we're now hearing sort of this delay in estimates until the end of the year.
Yeah, it's fascinating to watch. And certainly the move down in oil and commensurate move down in gasoline really puts a lot of pressure on the Fed's long-term goal of 2% price inflation. It's going to be very hard to achieve that this year with oil having just been cut by half or more. So the Fed's really got its work cut out for it this year. I think these minutes and every Fed observation this year, very important to watch.
What are your dot charts telling you,
Carl?
So
the key to where the Fed is likely to be at the end of the year in terms of the funds rate goes to the dot plot that they put out at every other meeting. The dot plot back in September suggested there would be 5 rate hikes this year, assuming they move in 25 basis point increments. As of the December meeting, that fell down to 4. Rate moves, which meant they pretty much had to go at mid-year at probably the June meeting.
Right.
But if we look a little deeper into the dot plot, because we have a lot of hawks on the high end of the dot plot who are not voting members this year, and many of which are retiring, if we remove those dots and look at the dots of the voting members, it implies only about 3 rate increases this year, which means that initial liftoff could come as late as the September FOMC meeting. I don't think that's really what a lot of Fed watchers are anticipating right now. It's a very dovish Fed this year, more dovish than last year.
Yeah.
And if we look at the core of the dot plot, it suggests they're going to be moving more gradually than a lot of people.
And 3 is one more than what Nick is talking about,
Yep.
you know, that the consensus is mentioning. But Nick, you know, this doesn't seem to be dragging down the markets, but what could drag down the markets? We've seen oil, for instance, which is supposed to be a net positive, right, for the economy, has actually been the source of some volatility and declines here.
Yeah, it's going to be a very interesting horse race to watch because on the negative side, we know we're going to lose some jobs from the oil patch over the course of the first 3 or 4 months of the year. Maybe as many as 150 to 200,000 jobs by our estimate. Then there'll be the long-term, hopefully positive impact of other industries kicking in with hopefully pretty good multiplier effects. So as consumers take that money that used to go to the gas pump and spend it somewhere else, else, they do the incremental hiring and pick it up again. But it's going to be the first 3 jobs reports critical to watch this year for that factor.
All right, Nick, thank you so much for joining us.
Thank you.
Nick Colas of Convergex. And also thank you to Carl as well, Carl Riccadonna, our Bloomberg economist.